Your mortgage payment is about to skyrocket. And if you don't understand what the Bank of Canada is doing, you could lose your home, your savings, and your future. This isn't fear-mongering. It's the financial storm nobody is warning you about. Part 1. The emotional gut punch. What's happening right now? Let me ask you something real. Did you ever imagine that you'd feel trapped by your mortgage? That you'd lie awake at night doing math in your head, trying to figure out if you'll be able to afford next month's payment? Because that's exactly what's happening to millions of Canadians right now. People are refinancing at 6%, 7%, even 8%, after getting used to 1.5% or 2% during the pandemic. That $2,000 monthly mortgage is now over $3,000. Some families are cutting back on food, canceling kids' activities, maxing out credit cards, just to stay afloat. And the worst part? It's not over yet. Part 2. What is the Bank of Canada doing? Let's break this down. No jargon, just facts. The Bank of Canada sets the policy interest rate. This is the rate that influences how much banks charge you for loans, like your mortgage, car loan, or line of credit. Why are they raising it? Because of inflation. Too much money in the system. Prices going crazy. To slow things down, they make borrowing more expensive, hoping people and businesses spend less. Sounds good in theory, right? But in reality, it's you, the homeowner, the average Canadian, who's paying the price. You didn't cause inflation, but you're getting punished for it. Part 3. The hidden danger. The mortgage time bomb. Here's the real crisis no one's talking about. Most Canadians are on 5-year fixed terms or variable rate mortgages. Thousands of people locked in ultra-low rates in 2020 or 2021. But when they renew in 2025 or 2026, they're going to get hit like a truck. Imagine going from $2,200 a month to $3,300 a month overnight. That's $13,000 more a year, just in mortgage payments. And if you have a variable mortgage, you're already bleeding. Every interest rate hike is another cut. There's a name for this in finance, mortgage shock. And it's not just numbers. It's marriages breaking under stress. It's kids hearing their parents argue about money. It's people forced to sell their homes or take on second jobs just to survive. Part 4. Real stories from real Canadians. Let me share what I'm seeing right now. A couple in Mississauga renewed their mortgage at 6.9% of their monthly payment jumped from $2,400 to $3,758. They've paused all RRSP and TFSA contributions. A teacher in Calgary had to move back in with her parents after selling her condo because she couldn't afford the new rates. A small business owner in Vancouver took a line of credit to cover mortgage shortfalls. Now paying 9% interest and stuck in a debt spiral. This isn't about bad decisions. It's about a system that changed the rules mid-game and left hard-working Canadians holding the bill. Part 5. What you can do. Right now, here's what you must do immediately if you're a homeowner or planning to become one. 1. Know your mortgage variable rate. You're already exposed. Fixed rate? Check your renewal date and start preparing now. 2. Stress test your finances. Can you handle a 2 or 3% rate increase when you renew? If not, start adjusting today. Cut unnecessary expenses. Rebuild your emergency fund. Start saving for higher payments now, even if you don't need to yet. 3. Shop around before renewal. Never just sign the first renewal letter from your bank. Use a mortgage broker. Negotiate. Ask about cashback mortgages, extended amortizations, or blended rate options. 4. Consider extending amortization. Yes, you'll pay more interest long term. But if it means lowering your monthly payment and keeping your home, it might be worth it. 5. Explore income boost options. You don't just have to cut expenses, you can increase income. Start a side hustle. Rent out your basement or a room on Airbnb. Sell unused items. Freelance. Use AI to create passive income streams. Your goal is to widen that gap between income and expenses before it closes in on you. Part 6. What if you're buying a home now? If you're planning to buy your first home, this market is risky, but it's not hopeless. Here's what to focus on. Buy less than you qualify for. Lock in a longer fixed rate if you want predictability. Get pre-approved, but don't overcommit. Save for more than just the down payment. Include legal fees, moving costs, and a buffer for rate changes. Remember, owning a home is a long game, but if you stretch too far too soon, you might not make it to the finish line. Part 7. The system is rigged, but you can outsmart it. Here's the part that stings. The banks? They're fine. The government? Still collecting taxes. The wealthy? Still buying real estate in cash. It's the middle class that gets squeezed again and again. But you don't have to be a victim. Not if you educate yourself. Not if you make strategic decisions. Not if you treat your mortgage like a business, not a blind payment. This is your chance to play smart, or pay dearly. Here's the truth. The next 12 to 24 months will define your financial future. Ignore this now and you might regret it for the next 10 years. But face it head on today, and you'll be one of the few Canadians who not only survives this mortgage crisis, but comes out stronger. Subscribe to Financial Mo, because in my next video, I'll walk you through the exact steps to refinance your mortgage in 2025 without getting crushed by high interest rates. Don't wait. Don't be caught off guard. Learn now or pay later.